going to be doing this every month. So this is my first time to do this meeting. And what I decided to do was that, we've got people that have different levels of questions, and the best way to do things, I think, is panel style, where you're able to ask questions and then kind of get other people's questions, and maybe they ask something that you actually wanted to know. And then, because you're not alone in your questions that you have. So unfortunately, y'all, on Facebook, I'm not going to be monitoring that question set that might be popping up. So once I finish, I may be able to migrate over there and go look at some. But if you have questions, anyone that's watching as we go, just post them, and I'll get to you. So let me show you guys a presentation that I put together, and I'm going to just hit kind of some of the highlights of it. Because there's some things that, from the passive investor side, when it comes to getting into group investments, what I'm talking about when I say group investments, it's very much like layman's terms of how to describe what it is that we do when we invest together. You can do group investments and syndications and crowdfunding, and there's different ways. You can do a Reg A offering. There's different ways that you can pool people's money and resources and deals together to be able to group invest, if you will. So what we're going to cover today is a little bit of specifically group investments that are syndications. Tenants in common is another way that we can do this. I'm not going to go into the specific structure this time. But basically, here's the premise of the benefits that you get doing the group investments. And then, like I said, I want to share with y'all kind of what I've been cooking up, and some of the ideas that are feeding all these other different resources into this ecosystem that we have and we're building. Let me see. So yeah, like I said, if you guys have questions, let me check one more time and make sure everybody that's trying to get in, because this has a waiting room, that they're in and not waiting. Okay, I'll actually put that up on the side. Okay, let me get going, and I'll share this, or present it, and I'll skip around a little bit just because this is a little boring and I want y'all to hang on. So passive investing in apartments specifically is what we're going to cover as far as group investing goes and what it can do for you. So if you ask me what it can do for the average investor, typically it provides strong returns and helps the investor to get their life back. So this is a little bit about me, and this is actually wrong. So now I'm up to 871 doors, I think is what it is. And then we'll close on another 111 units next week, be a little closer to 1,000 doors. I also am a licensed real estate broker. I don't practice as far as brokerage very, very much right now. That would be more applicable when things get a little distressed, as being able to use that for, doing deals. I was a former single family flipper, and I'm an advocate for women's independence and financial inclusion. So it's really important for me to include women in everything that we do, and then also provide opportunities that might solve problems as far as, lowering the barrier to entry, making things more accessible, making things make more sense, and providing more opportunities for more women that may not get to invest in these types of group investments until they're in their 50s. I'll kind of get into that. So there's this situation that people get into where they don't have all the time in the world to be able to go out and figure out how to do this entire industry, whether it's group investing or syndicating in a office building, or in a apartment complex, or an RV park, or I'm just giving examples for real estate. For example, you can do the same thing with gold. You can do the same thing, honestly, with crowdfunding for tech companies. You just are an equity owner in a different way. But point is that you have to kind of evaluate your time and your funds that you have available to figure out, what works for you. So for some people that don't have an abundance of time, they're running another business, whatever it is, they just realize that they can't do it all. And that's kind of the breaking point of, yeah, I'd love to go out there and learn a whole new industry and operate a big business. That's, not what I currently do. But then that stops your ability to make money as a specialist in the thing that you are already good at, So that doesn't really make sense. So here's what they run into. They can't do it all. So for example, what's part of what we do, or what a sponsor, we call ourselves, or principal in a group investment would do, is they would find and analyze good apartment deals in this situation full time as a job. And then we get trained to spot deals. So part of it is experience, part of it is mentorship, part of it is honestly, I guess that's part of mentorship, being able to lean on your crowd, your resources, your peers, for advice and for resources. And that just comes with being plugged into this network in this industry. So another thing that we do is we negotiate, we inspect, we raise money, we take care of everything post-closing. Managing these kinds of projects without experience is a total disaster. I mean, even today I got told about some kind of a program that we could get into to get windows comped based on our income level of the property, because we do workforce housing. Oh no, we can't do that. And I had to go lean on a couple peers, and they're like, yeah, you can. You just have to apply this way, lean on the residents, do it like. So people will give you the runaround all day if you don't know what you're doing. So it's just a disaster if you don't at least have experience or people with experience that partner with you. And again, risking your capital to secure deals is part of that full-time job. So going into a property that we are really confident is going to turn into a good investment, we upfront our capital to go take on the asset while we're just checking it out, basically. And then as we check it out, that money stays out there in the world and is illiquid and is risk capital that we put up front, even though there's nothing closed, there's no equity, and we could lose it depending on certain things. So you'll also need to, if you get into this new industry, you'll have to execute your plan, rain or shine, based on an experience for us now currently, at least a minimum of 5 years to 7 years these days, as far as, hey, your business plan is going to take that long to execute. So you got to show up rain or shine. There's really no like, oh, I'm tired. It's like you just got to keep coming. So until the business plan is executed. And running a large company, when you're looking at getting into multifamily, is no longer flipping houses. It's no longer a hobby anymore. So what will happen also, or I've found in my experience, what happened was that you'll have to kind of start over. So again, you're starting into a whole new industry, and then you're not going to be pursuing your purpose because you're going to be starting from ground zero, learning everything. So here's a couple of the areas of a new big business that you'd have to learn in this specific industry. So you'd have to learn how to run operations. That's something I'm really strong at. Learn financial modeling, and specifically for multifamily apartments. So analyzing your deals based on a lot of assumptions and different analyzers. Learning your property management software. So there's Yardi, Resman, Appfolio, RealPage. I mean, there's a whole list of different softwares you have to learn, plus be a little bit dangerous with accounting. I've had to learn because, again, people are always trying to, if you're not aware, if they don't know you're aware, they always take advantage. So you got to learn all these different systems, also how to direct commercial real estate construction crews, because again, same thing. That's just another part of your business, that you have to be over and be able to manage and operate effectively and have a knowledge base, because people will always push on you to take advantage. I hate to say it, but they just do. You got to spend your time project managing. So again, using your time, and when you don't have a whole lot of it, that would be literally impossible. Staying available also means less time for hobbies that you may want to start or continue. So kind of sacrificing some of your personal life. And then honestly, what I've seen from my experience is, until we have bullet trains and flying cars, right, and we're close to it, but right now we still are driving. So we're spending a lot of time driving without family. So when you close on an asset in this industry, everyone's all excited. They're like, yeah, we want to go to the property, blah. And they'll go with you like one time. And the investors do the same thing. I'm like, come on out. But if it's a 30-minute drive, or even, I've had up to 5.5-hour drives one way, they might come one time or never, and then they just get tired of it. So you'll spend a lot of time driving without people in the car, without family, either listening to audiobooks, on the phone. And so just taking all these things into consideration, you're kind of starting over if you're going to say, oh, I want to be active and I just want to jump into this new investment by myself, as a newbie. So where things really break down, like I mentioned, is time is limited. You end up spending more time searching than making money in the beginning, because you're new and you don't know what you're doing. I've lived it, lacking time to pursue your passions, again, like I mentioned before. And the reality kind of sucks when you really look at yourself in the mirror and you go, oh, I don't have financial freedom, because at the moment when I'm starting this and I don't know how to run things and get, call people and get it solved in 2 seconds, you don't have financial freedom. Financial freedom is really where you're not trading time for money. So that's really where people go, I quit, or I'm not doing this, or whatever. And it may take them a couple of years to get to that breaking point. So the solution I'll just present to you right now is to get passive income from experienced sponsors. So it's just another name that we use for like a deal lead, a sponsor, someone that puts together the group investments. So this way you can focus on your mission or your why in life, instead of waiting until you're later on in life to even try to start. So what a good sponsor would do, or the leader of the group investment would do for the investors, is they would make their investors money. Duh. But in specifically when it comes to multifamily, what a sponsor would do is they would find the deals, they would negotiate them down, they would secure the deal with their risk capital, they would raise funding from a lot of investors and have they would raise money. Essentially, they would secure multi-million-dollar loans that you would actually need to have Fannie Mae or Freddie Mac multifamily commercial loan experience to be able to close on, and or sometimes just bank loans that are like, $15 million loans. And you'd have to have the liquidity and the net worth to be able to do that. So that's part of the thing that the team provides, is being able to do that. And then also, obviously taking the risk as signing on these loans. So honestly, when people say it's non-recourse, there are still definitely carve outs, is what we call it. So when something isn't going right or whatever, the bank can basically make it recourse any second. So it is risk that the team takes on in as a favor or a service, if you will, to the other investors. You also get your sponsors' knowledge base to operate, which is great. They worry about your tenant turnover, the upkeep on the properties, and even the capital improvements by their set business plan with consistent execution. Again, you can't just get into it after 2 years and go, I don't want to drive 5 hours, or I'm bored, or, it's raining, or whatever. Like, you got to keep showing up. And then again, utilizing your knowledge base to do things even beyond the business plan sometimes, so that we can overperform. Your sponsor would also be involved in taking on tasks and projects. So they would inspect, they would improve, they would asset manage, they would refinance, triage disasters, make sure that there's accurate accounting, consistent reporting to investors, distributions. They'd take care of tax forms being delivered to investors, and then position the properties for sale, and then so much more. There really is so much more that happens all the time. And so, when you're getting into group investments, why does an experienced sponsor matter? And again, this is really applying to like any kind of investment that's a group investment you'd get into, whether it's multifamily, or like I said, if you like my first investment I invested into, I had $5,000 in an IRA and I invested into a house. And so what we did as an investor group is we put $5,000 down a piece, or some bought more units or whatever, but we bought a portion of a house note on a house. So this was a rental house. So it's similar, but again, this is what we do with apartments is just a bigger version of splitting a rental house, up between us. So again, when I invested in my first single family note, same thing. It took me about a year to know the sponsor who was putting those deals together. And she was someone that just really had impressed me and made it through a couple of big storms, and did the right thing when things didn't go well, which is really important. So experience really does matter. So that's kind of what this slide is going over, is that, as a company grows, as things change, cross-functional collaboration and communication is so important. And so that takes professionalism, that takes clear and consistent communication, that takes maturity, and again, experience, because experience helps us to know what the next steps to take are, no matter what happens with the market. So as I mentioned, usually the sponsor group, there's definitely more than one, for sure. And we all have our different levels of experience and knowledge. And I even have some people in my life that are not necessarily directly in the investment, but they're kind of like a part of the board of advisors, if you will. 40 years of experience, 25 years. I mean, they have different experience levels. So when we get into a corner, it's just important to have that experience. So this is pertaining to multifamily investments specifically. These are some investment benefits that you may not expect while looking into multifamily group investments, particularly. These change when you look at other types of investments, and this presentation is mostly going over a group investment, what's the advantage. So specifically for this niche, you get to take advantage of downturns. So when the market's not doing so hot, you get to take advantage of that because we have more units or properties to spread the investment out across. So meaning two sides to that. When the market's down, typically people become more renters. And then also, if we have an issue on the property where there's a vacancy issue, the larger the property is, the less the vacancy actually affects us as owners. So, if you have 200 units and you have 20 units that go vacant versus a 30 unit property where we always use this analogy, like a 4-unit property, and you have like half the building go vacant, or 75%, it's just 3 people leaving, which, would take, if you only invest in a community where there's one main industry that's there and that industry leaves, that may very well happen. So the larger properties that we have, it's an advantage even when the market's down to be able to have those properties, because it doesn't affect the income and or the occupancy, aka income, nearly as bad. Here's a kind of obvious benefit, but some people don't think about it. So as a limited partner type investor in the group, you just collect checks and watch your money grow. So we call that mailbox money. That's why I have this little envelope and a little dollar sign, because really as a limited partner, that's all you have to do. Another thing that's great about specifically apartments, and depending on the other investments you do, building a reliable stream of passive income without taking on too much risk. So for example, I had a conversation with someone the other day. I'm going to invest a certain amount of money with apartments. When you first get into investing in apartments, there's going to be kind of like a dry period, I call it, where when you first invest in a value add deal, each different industry, each different level of apartment, A class, B, C, D, they're all different with how it works and whatnot. But for us, workforce housing, we always have to fix a problem with the business. So when we fix the problem, it takes time for us to analyze the problem, put funds in where they're going to make a big difference with, curb appeal, with amenities. We change out the resident base. We get rid of all the bad, not all of it, but most of the bad debt or people that are not paying, make sure that goes to collections. We just get in there and basically improve the community. And that takes time. So because it takes time, we don't distribute cash during that time. We make sure that we have the property completely stabilized. And then at that point in time, we start paying out distributions. So once distributions start though, ours and every different, sponsor is different. Ours are quarterly, other sponsor teams might be monthly, might be annually, biannually, whatever it is. But basically, once they start paying out distributions, for the most part, depending on your agreements, that should continue until the property is either refinanced and you're made whole on your investment, plus the projected returns you're expecting, or it sells and the same thing happens, or better. So it just depends on how your investment's set up. But the point is during that time, you should have a pretty reliable stream of income. And then when you make your, say, for example, you invest in a deal, an apartment deal, and your money's doubled in 7 years or 5 years, or whatever it is. And then you go, okay, I put in $100,000. Now I have $200,000, and now I can invest in another apartment deal, but now I'm investing with more money. And so then what happens is your reliable passive income is greater because you're investing in another deal with a larger amount of money, with, say, similar projections. And so all you have to do is continue to do that in a cycle. And then sometimes you can take that money and invest a little bit in this sponsor's deal or that sponsor's deal. Anyway, point is eventually the idea is to ramp up the reinvested cash into where it replaces your active income. That's what a lot of people like to do. So that could be a very reliable stream of passive income once you get past that dry period, I call it. You're also able to build your portfolio without actually literally going out with binoculars, knocking on doors, making deals, raising the money, blah, 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 like the whole thing. We do that, and you're able to build your portfolio without actually having to do all of the really heavy lifting, which is a very slow process if you're trying to do it by yourself. So for us, I team up with other sponsors. I have the two main groups that I invest with. And so all of our eyes are all out there looking for different things all at the same time. And the more people that you have involved, the more scalable something is, the faster that you can build that portfolio. So we try to provide opportunities as often as we can. However, we do right now in the market have to look at about 100 deals-ish before something actually makes sense to execute on. So it's a lot of no's, but anyway, point is that you can build your portfolio still without having to, spend all of your time and moving very slow, doing it yourself. With commercial real estate, another benefit. So with commercial real estate, such as apartments or office space, there's also a potential for higher returns on an investor's dollars due to multiplying units income. I kind of alluded to that earlier, but again, so the power of commercial real estate is, for example, in this situation, let me turn it this way. If you were to passively invest in a group in a house like I did when I first started, my return was 8% per month. But I only invested $5,000. So that's very little. And then based on the way that I invested with a retirement account, the fees that I was incurring at the time, I've learned how to get around those now, but at the time almost completely eat up my return. So if you're investing in something with a little bit higher dollar amount and a commercial property, every time the commercial property makes income, it has a multiple effect. So one example, a house might have, okay, let's put $5,000 into the kitchen. Maybe on the back end of selling the house, that kitchen might be worth 1.5 times, or it might be worth, it's basically, you're going to get 100% of your money back. So you put $5,000 into a kitchen, for sure, you're going to get $5,000 back on your sale, and maybe a little bit more depending on what you put in. But when you're going into a commercial property and you are going into, say, one unit, and you're reducing the expenses that we as an owner have to pay on that unit by like $10 a month total, because maybe we took part of the bills, utilities, et cetera, billed it back to the tenant or resident, excuse me. And let's just say $10. So if we have a 200 unit property, and then you're taking that $10 multiplied by 200 units, that's that much money per month that we're now saving. And so what happens is, based on a total net operating income, when you increase your income or decrease the expenses, I can do the formula in a minute, NOI, but basically you're reducing your expenses or increasing income. That provides a multiple of value. Here's an example. So, and this is not a good unit example, I need another one, but just an amenity that we put in. So we put in a storage unit. It was $20,000 to put in some storage units, 12 units. And long story short, based on the like 5.5% to 6% cap rate, which is part of that NOI calculation, that 20K equaled $180,000 worth of value that was created like that. And that's the power of multiple units in commercial real estate. So whether it's office space, you do the same thing. Whether it's, we did a self-storage session last night talking about how that multiplier works, but it's the same thing. All commercial real estate is based on the valuation of the net operating income. Sorry, that was a very long one, but I just want y'all to understand the power of how, utilizing group investments, especially in commercial properties, is huge. Here's another advantage you may not know about. So investing through a sponsor can provide the desired level of passive income and less risk than a stock or a bond investment. I'm not going to dig too much into that. I just personally believe, and I guess it doesn't matter what I believe. No one cares. But what I've seen is that sometimes, based on the market, based on overnight changes, that stock market can be a roller coaster. So some people prefer lower returns, longer term, more stable, and that's something that real assets provide. So again, I kind of said this earlier, but you can make passive income without risking too much of your own capital. As a limited partner in a group investment, you're putting up your 100,000, 50,000, whatever it is, 25,000 into the deal. And this is after the point that the leader has put in their initial infusion of earnest money, legal retainer soft costs, all of the inspection soft costs, all the risk money. Basically, you come in after they've already put in that money, and they've waited about 30 days to look under the hood and find all the problems and make sure that their numbers still make sense. Then once that goes to the point of rechecking our numbers and going, okay, we've seen everything still makes sense to move forward on this purchase. Now we'll go to the investors and have them put their capital in. At that point, you have low risk on your investment, because again, we've already put up the risk capital, we've already checked everything. So you don't have to ever kind of go up in the beginning usually and input your capital before it's a secure investment. And then the last thing that I'll cover on some benefits you may not know about are that saving money on taxes by ensuring that you don't make passive income in a higher tax bracket is a big advantage of real estate group investments. Again, it doesn't always apply to every other thing. For example, stock investing, there are certain types of depreciation, and really more so, they're not depreciation, pardon my French, that's here, but in there are capital gains benefits to stock investing, but I'm just going to talk about what I know here, and this is real estate. So you obviously want to do, or I want to do personally, what I can to reduce my tax burden and what I pay out in taxes. And so really think of it this way. This isn't going to equate to this equation here, but essentially, if you said, oh, I make, $500,000 a year, but I pay $250,000 in active income tax because I do nothing to reduce my tax burden, you actually make a $250,000 a year. Or if you made $250,000 a year, hypothetically, and you paid no taxes, you likely work half the amount of time that you did to make that 500,000, but you make the same that you did post active income tax burden. So I don't know if that makes sense, but it's more about what you keep than what you make. I mean, really, that's my personal philosophy. It's all over my website, but that's part of certain types of group investments that you can take advantage of getting into a better tax bracket or paying no tax sometimes. So speaking about that, this is specific again to passive income, to real estate passive income. So you have this thing called K1 income. And what that can mean for you, for example, if you practice other types of real estate as a professional, what that can do for you is give you real estate professional status. And this is a question for your CPA. But basically what that means is that, so if you have, passive losses, so your first year, you invest in a deal, like I mentioned, it takes us time to distribute all of your returns because we're stabilizing the property. So say year one, that means that you get a paper loss or a passive loss. So, oh my God, look at my K1. It's like negative 50 grand or whatever. Mine was like 15 or whatever, but it's a negative number. What does that mean? That means that can be applied towards some of your active income taxes to reduce those other taxes or your taxable income. And then if you're a real estate professional, you can use 100% of that. Plus you have no passive loss limitation. So for example, if you had $100,000 in passive losses, and then as a broker or as a house flipper or something that is a builder or something that's involved in real estate, or I mean, honestly, if you have like a rental business and you look at houses like a lot, that would usually count. Again, CPA question. But say if you made 100K in passive losses and you made 50K worth of active income in real estate related businesses, so then you offset that 50K in active income taxes you have to pay. So you're like, oh, okay, I'm at zero tax liability, cool beans. Now what do I do with the remaining 50K that I have? Normally, if you were like a single individual, you would just take that as I believe a carry forward or a carry back, depending on your past or forward years and your tax bracket and some other stuff. But point is if you had a spouse, a significant other, a partner that is either not in real estate or in real estate, it doesn't make a difference. They get to now benefit from those additional tax benefits or tax losses, passive losses, excuse me, that you get from that first year of losses. So it's a potential benefit. I'm not saying it applies to every single person that's listening or watching right now, but just think about it. And again, like I said, some of this stuff has now changed because we've become a little bit we've just changed a little bit as a society. And so now, for example, like I mentioned, if your partner, so it doesn't have to be that you guys are married, but anyway, there's certain caveats that this can be applied to. Another thing about taxes and being a passive investor that's cool, I think, is that you have the possibility also to use your retirement plans tax-free to invest. So like I mentioned, my first investment I ever did in a group was a $5,000 investment. It was in a house note. Again, it was passive. So I had those K1 losses to balance out my active income a little bit. And then UBIT and UDFI is another tax that you're subject to if you invested into something passively with your retirement accounts that has debt on it. So if you invest in something like all of the stuff we invest in has a loan on the property, then you're subject to those extra taxes. It's unidentified business income tax, unidentified something tax, but basically it can be up to 40% of your gains or 40% of your money that you make. So we don't like that. So there's ways around that. And again, I'm not going to go through all of that, but solo 401ks, not unidentified, qualified retirement plans. There's several different types. There's a couple type of accounts that you can change your retirement plan into that's self-directed that avoid those taxes. So you're investing with money that is tax-free. It will be tax-free when it's invested. And while you're growing it, you're also not subject to those gains taxes as well by changing this type of account. So again, we can obviously answer those questions offline, but I just want y'all to know. And again, this is highly specific to multifamily investing. This isn't the same in every type of group investment, but just, want to clarify some cool stuff that can be the case. And then also when you're a limited partner, your liability of loss is limited to your investment. So for example, as a general partner or an active deal sponsor, like I mentioned, if I sign on a loan that's a $17 million loan, or like I've got, a $9 million loan, geez Louise, a lot of crazy stuff that I've signed on. So what that means is, say, excuse my French, but SHIT hits the fan and everything's going wrong and, all of the sponsors die and there's one of us left and the bank has gone to the property to scalp income to pay for the debts that we owe on the property that we've been behind on paying for a year. We never paid just because we didn't feel like it, or like I said, we all died. Then basically that remaining sponsor, say it's me or whatever, then I am personally liable for that debt. they will come after me. They will come after my businesses. They'll come after my liquidity. They will come after, in Texas, if we have an asset, it's a homestead state, so they will not come after my homestead. So my house will be safe. But I tend to actually rent and move. So that's not the case for me. So point is that you as a passive investor, none of that ever applies. They will never come after you, your businesses, your liquidity, anything like that. You're limited in your liabilities. That's why we call you an LP, limited partner. So that's something that's a benefit to being a part of a group investment as a limited partner. And did we mention there's less work with passive investing? So obviously the capital that you invest can go further, meaning that passive investors get a better return on their investment than those who don't use passive investments. I know that kind of sounds dumb, but I have a lot of people that I work with that just cannot wrap their mind around passively investing. They have to go build a house. They have to do the deal themselves. They have to just do it all. And so they only can do 1 to 2 to 3 at a time, maybe, versus being in a deal where you make better returns. Maybe it's like 9%, and then it's 200% overall when they sell, which is typical that we do. And then they get the tax advantages. They did none of the work, and they're also still able to make that active income doing all that other stuff too. So those people that would participate in passive investments in this example, or say if you have a non-real estate main job, same thing, you're making double, or triple or whatever the income that you could make if you just did only active investments. So it's kind of duh, but just consider it. So this is specific again to my industry, and each different type of investment is different. So how can you currently invest into a group investment of this sort? So you can use cash. Cash is kind of dying, but cash, you can use it. Retirement accounts, like I already mentioned, is a way that you can invest into group investments tax-free. And then also crowdfunding is another way that you can use cryptocurrency. Some sponsors, very few these days. It will grow over time as we get more comfortable as an industry, but can use cryptocurrency because some banks are taking crypto, and then therefore we could work with the bank. But then, like I said, crowdfund Main Street here because I'm working on a crowdfunding offering, which would actually be able to, on the back end of their platform, they'd be able to take your crypto, and then we would just be on the offering side. So there's a couple different ways that you can get involved with group investments. So I'm not going to play this or click this, but you can go to our website. There's a ton of resources at theapartmentqueen.com up in the top menu bar, probably too many, of how you can get involved with us in the programs that we offer our active and passive investors. Currently, we have over 400 investors with all of our different properties. And they are all pretty happy, I think, because especially now after COVID, they're all being paid. So you can become one of our 400 plus investors. And I'm not going to go through this in super detail because I'm kind of like dry in the mouth and I'd like to take some questions, but this is our investment process, and every different, if you're investing in gold, if you're investing with any other sponsor, it can be different than this. But to make it super fast, this is like a diagram of the fact that, one, we want our investors to be educated. So being on here is like the first step, reading some, getting involved in webinars that talk about how taxes benefit you, what to watch out for, talking about different markets, getting educated. Like I really like to give economic updates, et cetera, et cetera. So staying updated, number one, is the best investor that we find. Number two is making sure that you're qualified for the type of deal that you're investing in. So not just throwing your money at the wall and hoping it sticks. So we actually, as a team, we have a quiz that we have our investors take once we have met them or gotten their contact info. And we then figure out if you are accredited, non-accredited, or neither. There's nothing bad or good about any of them. They all qualify for different things. But then once you know that what you qualify for, then you can start reviewing offerings when they become available. So this is just number 3, is reviewing, the documents. There's usually quite a bit of legal documents to look at. So it's also important to have a team of people that can help explain things like risk to you. And then again, that's also part of your education. But I have an attorney, several of them. I have a CPA that's very important too, because you want to also look at your tax situation and figure out, does this investment help or hurt my situation? Because they're all different. Some companies offer you different types of share ownership where it's like, oh, you just get this or you get that or you get the whole enchilada, or, you got to be aware of all that stuff. So it helps to have a team to help you evaluate. Typically for us, once we have some kind of a deal put together, we will hold or host a webinar, which is basically like story time. We get to talk about the deal that we have rustled up, and we get to talk about the pluses and the minuses, the risks, the benefits, and really what our business plan is and what we expect to see on that deal. The investors, for us, when they want to, or they want to show more interest in actually invest, and they've decided it meets their investment criteria, they can simply go into our investor portal, review documents from the portal, and then they'd be able to sign those documents, execute them, and then basically process their wire, ACH, their payment, their investment within a certain time window specified. And then you would be receiving an email once we close, and that closing email would give you details about, okay, here's how to set up your bank account checking ACH info. Here's how often you can expect reporting. Here's when we will start reporting. Congratulations for closing. And then the last little thing is this mailbox, because then pretty much moving forward after a certain time, you'd be receiving mailbox money until the deal is, until basically you've gotten your projected return back. So that's how our investment process works to invest in our group investments. There are a couple of caveats or different ways to do this too. Like, for example, we've taken in a partner. They will go through almost all the same steps, but instead of coming in with like a retirement account, we can have some partners come in with a 1031 exchange. We've had some partners, I've done this 3 times now. We have a full program for it, where they can actually take money from say if you're in Seattle and you have like a 4-plex, or in New York and you have a 6-plex, and come to Texas and come buy 30 units with us. That keeps your 1031 tax free, and typically it will double your net worth in your portfolio size, kind of like overnight. But there's got to be a level of, again, awareness, education, be able to collaborate with the team and let us lead that investment. So that's another way to get involved. And then there's a couple of other ways if you're interested in being, or if you've already been experienced being an active investor. So this is more just talking about passively, but group, there's still the active and the passive in the group. So it's a little bit about us. I'm not going to click on our story, but I'm happy to share this. It's a 3-minute long video about our why and what we're doing. But just a little snapshot. Started in 2018. By 2020, we had 400 investors, 20 million raised, 750 doors. And then as of this year, we have put together our first crowdfunding option for non-accredited investors, working on reducing the barrier to entry specifically for women, because I have found in my experience that we save and we donate, and there's also a income gap there. So we have less slush money to invest with anyway. And a lot of us are single moms. And so typically we are paying for expenses up front and hopefully being reimbursed later. But the point is that in this situation, we want to make sure that women that typically have to wait until they're in their 40s, 50s to start investing with their retirement accounts when they're finally up to that 50K minimum or so that they can get investing earlier. So really that's our newest invention that we started working on. And then I'm going to cover, so this is me again. I'll give you a little bit of info, and then I'll pop into see if we have questions on what I just said. And then I'm excited to show y'all a little bit about this ecosystem that I'm building. I'm excited to show you kind of, yeah, this is the, apartment investing side, but like, how do I get there? I don't know. We know. Okay. So let me check for questions, but if you want to contact us for future opportunities, specifically with the Apartment Queen, you can text me at 214-699-8810 and just text me, send me the deal, and I'll get you the login information you need to go look at our future offerings. That's also my email, admin@theapartmentqueen.com. And again, this is my bio, but it's wrong. So we've acquired a couple more deals since then, but again, still an advocate for women's independence and financial inclusion. So I think that's the end of this. So I'm going to exit out of here, pull up my ecosystem diagram, and then I'm going to check for any questions real quick if y'all have any. Let's see, on Facebook, do we have any? Tim Price. He just says hi. Okay. That's Facebook for you. Okay. Anyone that is on Facebook, or not Facebook, Zoom, I'm going to take a break real quick of talking and let you guys ask any questions. So you can unmute yourself or put it in the chat, either way. Okay. So I got a couple questions in the chat. You mentioned lowering the barrier to entry. What do some of the entry levels look like, samples? So typically whenever we're doing an investment, typically the minimum is $50,000. If we have a huge raise, for example, $9 million, like we almost had one of those coming, then it would probably be 100,000 minimum. However, like I mentioned, this crowdfunding offering that I'm working on is hopefully going to be published by January. I had one already published earlier this year, but unfortunately the attorney that I chose to partner with had never put together a crowdfunding offering. So there were a lot of things missing and it got flagged and I had to redo it. So we're doing it right this time. And I've got an attorney out of DC that knows what she's doing. Point is that can be taken down to a minimum of $1,000 for unaccredited, unsophisticated investors. However, because that would build that, what we call a cap table or a table of all the investors, that would be, for my fund, we have 4 million left out of the 5 million to raise. That's a lot of investors. That's a lot of, there's going to be certain levels of, okay, if you invest under X, then you wouldn't be able to call and text and email and, go on the property all the time. That would be impossible to maintain, but more of like a Kickstarter kind of investment, or more of a, I'm trying to remember, Indiegogo for like a tech startup kind of investment. So what I'm thinking of doing is probably similar to my first investment, probably about $5,000. And then I'll show you all the ecosystem, because the next phase that I haven't built out yet would be connecting with nonprofits. And when we do that part of it, we're going to have to lower the minimum. So I'm going to have to figure out some more things. But again, this is just a journey in process, so that's part of the fun. But also, so yeah, we can go down to 1,000 with those platforms, but I think I'm going to do 5 when I get this offering published. We can get it published as early as January 1. So let's see. Jeannie, if I said that right, Laurent, you have a question. There it is. If I invest a lump sum of money, is that tax deductible as a limited partner or silent? Oh, there's a couple questions. Okay. So if I invest a lump sum of money, is that tax deductible? So that question depends on how you're investing. So for example, are you investing as a trust, as a retirement account? Are you investing cash? Where is that coming from? So it depends. And so it's not tax deductible in the sense of like, okay, I'm investing in a charity and I can tax deduct what I invest, but it can offset your income taxes. So like I had mentioned, first year of our investments, what we do is we would give you a loss. So it would be a K1 or passive income loss. So that passive income loss can help offset your active income taxes, depending on your tax bracket, the profession that you have, and a variety of other things. That would be able to answer the question of how much of that can offset my active income taxes. So that may be a conversation that you want to. You can text me also at that number 214-699-8810. That question, I'm happy to connect you with like a handful of CPAs that we work with that can answer that, because I'm not a CPA and I don't want to give you the wrong information, but there's a range of how much of that you can use to offset other active income taxes. So it's kind of like a write-off, but it's not technically the word write-off. So it just can be, or tax deductible. It can offset other income taxes. So it helps you net or lower your income tax bracket. As a limited partner is another question, or silent partner, is it pretty much hands off? Yeah, absolutely. It's hands off. Some of the investments, depending on your documents, you want to read those. They will allow you voting rights, but in specific situations. We don't want, 19 people, it's ridiculous, voting on every time we change the paint color, every time we decide that, oh, this manager is about to quit, we need to go hire a new one. We have to do all the interview processes and standard operating procedures for that. So really the hands-on people should be making those decisions that have the experience, right? It would be, I've been in an investment where we had a lot of new people who had never done this before, having way too much voting power. And so it just cost a lot of money and nothing got done. So it's important to have a leader that, for me personally, when there's 4 of us or 3 of us in a team and we have one that has, 100 properties and 40 years of experience, really at the end of the day, if we're between 2 answers, I'm going to default to the answer that person offered, because they obviously have experience and merit, so I trust people with experience. But point is yes, it's hands off, minus the fact that on major decisions, depending on the investment, you can participate in voting on refinancing, which you would want to do because that results in you getting a check, right? So you'd want to do that. And then also voting on sale, which you'd want to do that because, again, that's another situation where we're voting like, hey, we got offers, y'all want to sell, we can make you another big check and double your investment. So yes, you get to do some things, but mostly, yes, it's hands off. And so you actually also get to learn while you earn, which is another cool thing because you've got full access to the financials. You're able to see, I've been in properties where we've had flood, fire, And then we get to do reportings on how we're triaging that situation, how we're working with the public adjuster, the whole process. And so you also get to learn while you're in it. Another question, if I only have a Roth IRA, will that do as far as investing with a retirement account? Yeah, absolutely. We definitely work with IRAs all day long. And that's why I haven't yet done the crowdfunding offering, because I'm testing out the back end of a couple of them. I have to make sure that they have a robust onboarding process for investors that have retirement accounts. Because like I said, I got to look at myself, like, how did I get involved in this whole thing? I had actually less than $5,000. I had 3,000 some odd dollars in a retirement account from a corporate job that I had. And then I added money that I was making to that account to be able to fund my first investment. And so obviously what I'm saying is I invested with a retirement account. So I definitely want to mirror, how did I get, out of where I was in my life? And it was with a very small IRA investment. So yeah, for sure. We're making sure that our crowdfunding platforms and we've got a virtual assistant that works with investor relations and onboarding, that we do take investment, retirement accounts. And there's so many different kinds too. If y'all didn't know, like, people have TRS accounts, teacher retirement savings account, pension plans. There's also ways that if you are married and you have an active employer account, essentially retirement account, and there's a certain clause that an attorney can write up to essentially activate a paper divorce. So you're not getting divorced, but essentially what it does is it gives you the ability to remove the money from the employee's account, because it's going to be one or the other. Like, I know y'all are married, but you're two separate humans. And so you have separate accounts. The point is you can take that money out with each of y'all's written signature and approval, and you can use that money tax-free to invest into real estate earlier than you think. And there's other examples, that I've learned. So let's see, there's another question I missed. Let me go back. What is the difference between accredited, non-accredited, and neither? So the definition changed in March, and actually Jenny Casson, I'm just going to put her name out there because she's part of the attorney I'm hiring to do the crowdfunding offering. They're on the forefront, or she was. A man was credited with getting the crowdfunding offering changed and getting the new legislation changed in March, but she was the one honestly doing it. And I'm not just saying that, like, y'all go call her and talk to her. The point is so this has changed, and I'm not going to say what it used to be because it doesn't matter anymore. But as of March, what accredited means is if you are an individual who has $1 million net worth minus your primary residence, or two, if you're an individual person and you make $200,000 a year for at least 2 consecutive years, if you're a couple and you make $300,000 as a couple for at least 2 consecutive years, or new definitions, if you're a financial advisor with an active license with your Series 65, Series 83, and Series 72, 70 something. I can look it up. It's on the SEC's website. But basically, you would qualify as an accredited investor because you have knowledge of these types of investments. Also, a fund employee, like if you work for a company that has any kind of like hedge funds, real estate funds, etc. Again, you're a knowledgeable employee. If you are part of an Indian tribe or a company that owns 5 million in assets or more, and that company's LLC is investing, that counts. So sometimes you can partner up with other people or be a part of another group. Like, for example, what I do with dads and daughters a lot is, like, he's accredited, and so I have her as a family member come be part of that new LLC that they form. So automatically, because she's a family member, she receives accredited status. You can't do that with friends, really. Like, you kind of can, but not legally enough. It's easy with family. But anyway, the point is, because it could be like a trust structure. It could be a thing where, like, essentially the benefit is in her name and it's family, so it's easy. But so anyway, that's accredited. To answer that question. Non-accredited, what we call them sophisticated. So people get that confused where they think that sophisticated is like a higher rank or something. Accredited is like the most knowledgeable investor, if you will. And then a sophisticated investor is someone in my industry, for example, that has sufficient knowledge to vet the merits and the risks of any kind of investment, real estate investment that they would get involved with. Sometimes that means that they were an employee, or sorry, a C-suite executive. They helped build a business. They bought and sold other businesses. They're a entrepreneur that owns their own tool shop. I mean, there's a large range of what a sophisticated person would be, but somebody who essentially can have some knowledge and benefit and understand the risks and benefits of investing in a deal that has inherent risk. And then neither is somebody who is kind of neither of those. So for example, like my grandma has $6,000 and it's from an old employer account that she has on her own that's not, part of her marriage, or it's not, it's not being given to a grandkid when she passes. And so she decides, hey, I'm going to invest with this account on my own, but I currently make no income. I currently don't obviously qualify as accredited. And I also have never done a real estate investment in my life. And so I really am not sophisticated either. So the neither people would go for the crowdfunding offering. And then there's a chart of the levels of investment that they're allowed to make. And it's based on their liquidity, their net worth, their risk. And so what I found when I did it the first time is that ladies that I work with that normally would invest like $50,000, it actually would limit them somewhere usually between, like, depending on their income and all kinds of other things, it would limit them to like, 32 to 40, 45,000 or something like that max. So basically there's extra rules thrown on top of someone who's neither accredited or sophisticated to try to protect them from spending more than, like, for example, if they lost whatever they invested, would it change their life? So that's part of the crowdfunding, working with the neither accredited or sophisticated people. So like I said, it's just kind of everybody else. Let's see, Lindsay, when will we get an email when the crowdfunding opportunity goes live? I'm not sure, Lindsay, that depends on when it goes live. So I hate to be, snarky or whatever, but that last time I did one, it took 7 freaking months to find what I thought was the right person, put it together, get them to be willing to do it, because it's very work intensive, it's very expensive, and there's a lot of limits to it. It really is not an easy thing. I'm used to doing Reg D offerings, as in Delta, and those things are like, oh my God, they're like, for crowdfunding Reg C, as in cat, they had to audit all my bank accounts. They had to get all of my operational history, and they is FINRA. And then once FINRA went through like more than that, basically, and said, okay, there's no jail time. She's not producing any fraud. We don't have all the things they checked. Then she's allowed to have an approved offering. And then once you have the approved offering, then there's a bunch of other things I have to pay for to get it going. But again, it's all keeping in mind the type of non-accredited, non-sophisticated investors that we're taking on, because we as an operator take on an incredible amount of risk whenever we're taking on people that have never done this before. So again, that's my mission, to decrease the barrier to entry and make this available to women earlier on in their life, to where they can actually take advantage of the compound interest curve early so that it means something. But anyway, so Lindsay, to answer your question, it just depends. The attorney I spoke with, Liz, this week, she's a killer. She's got 3 other staff members, and they believe they can crank it out by New Year's. That's the goal. But these offerings cost thousands and thousands and thousands of dollars of my own personal money. So every time I do one, it's my own money, doing it. So I've got one more closing, to be transparent, in the next week or so. So once that closes, then my profits always go back into the business to go build something else. So once that closes, then I'll be initiating the process of starting that. And then as soon as it is live, if you are on our investor list, I guess that's a better answer. If you're on our investor list, so if you text me, send me the deal to 214-699-8810. I'll send you the investor quiz, and that will dump you onto our list. If you're on the list, you'll get it as soon as it's live. And actually, I'll probably send out a level of interest email before it's live to put you on a wait list, to see like, well, how many people really want to get in? What level of priority do we need to set up for them, etc. So yeah, I'll just text me, send me the deal, and I'll get that to you. Let's see, you put together a great overview. You mentioned watching webinars as our next phase of education. Do you have any recommended webinars? So if y'all go to my YouTube channel, I'm going to see if I can set it in the everyone in the meeting. Let's see, I have a thing, tube, APQ, YouTube. There it goes. It'll pop up. Okay, so I'm going to send this to everybody. And then for those of y'all who are watching live online, you can also just search this in YouTube. It's just, I think it's like the Apartment Queen, or may even be Kaylee McMahon on YouTube. But there's a couple of webinars on there that I did, specifically going over 1031 exchanges. There's a whole series on that I did with a company that does those, how that works, getting into these investments tax-wise. We did a good one recently. I try to plop in my webinars that I do. I've done several on different IRA structures. And so 401ks was the most recent one that I did with a friend of mine who teaches you how to get up to, I think it's like $358,000 into a 401k tax-free. There's a method by utilizing friends and family members and employees and starting a new LLC company, et cetera, that you can do that. And that has nothing to do with the new regulations coming out, which are capping the accredited, high net worth, qualified type investor. Legislation hasn't been passed yet, but it's gone past either the House or the Senate, where one of the judicial branches has the thumbs up. So it may not go well. And what that means is that the investor offerings that I have that are specifically where you got to qualify as accredited, those may just go away, where we can't even do those. And they actually make us force our investors to leave the project, which is going to cause a huge amount of issues. But anyway, point is the webinars that are involving 401ks and that method, and then anything I'll post on crowdfunding. I don't believe I've done one recently, but I will. And I think I'm going to do one on a fund because a lot of people don't understand how a fund structure works, including a group that I actually raise money with. But anyway, my YouTube channel, long answer, is a great place to find some of the recordings that I've done. Also, some of them, and not all of them, that I do in our app. It's called the SheVest app. That's something you can go to, where I've taken recordings of women who do all kinds of real estate investing, not even just apartments, like RV parks. One builds hotels, one passively invests in self-storage. I mean, there's all kinds of cash flowing real estate assets that are out there, but it's like, what's their pros and cons? What's their risk? How do they cash flow? How does it affect their taxes? And then from that perspective, it also would give you a good gauge of like, do I even want to get involved in apartments? Maybe you don't, and that's fine. But it's a good overview of like what's available. We're adding more because it's just in beta mode. So also the more downloads we get, we're working to get to 1,000 downloads. The more data that we get, and the more that we know what kind of professionals we need to bring into that app, what resources need to be added to it. So there's a couple of different places. I'd say YouTube and my SheVest app. Let's see, is there a deal analysis calculator that you can use, or any that you, yeah, for sure. We built one over COVID. It's kind of like, what did you do when you got bored? So I wrote a book, made an app, really beefed up that podcast. That's another place you can find some interviews there for info. But also we have a deal analyzer. So again, if you go to our website, theapartmentqueen.com, up in the upper menu bar, and I'm kind of changing some of this stuff, but in the upper menu bar, there's one link option that you can click that says underwriting spreadsheet or ultimate analysis or underwriting analyzer, something like that. But so my co-founder, Carolina, she built that thing off of 3 other software platforms and kind of put it together. It's very detailed, and that's how she is. So there are more tabs on that spreadsheet than on typical ones I've seen. But long story short, if you click up there, there's a free version. So you can click on that, try out the free version. Then also, if you want to actually own your own copy and then get some more one-on-one time with her, then you can just basically click the full paid version. It'll take you to her website, and it's like, I think it's like $300. And then if you use the code APT Queen, you can get $50 off to make it $250. So that's helpful, because a lot of programs I find, or mentorship programs, they charge like $30,000 to $50,000 to basically hold that as like the Twinkie of like, well, you need this spreadsheet to do your deals, or to even know what's a good investment to start with. And we're going to withhold that until you have paid the money and shown up to our group. And anyway, so this is a lot more affordable, I think, and built by a woman, or by a woman that I believe is very detailed, and most of us are pretty detailed. So anyway, long story short, yes, it's on the website. And then I included my YouTube channel in the chat if you want that. And that will also, I'm not sure with the deal analysis spreadsheet, if what you're talking about as far as medium-sized multifamily, I would say that analyzer would apply to anything that's likely above 6 units or so. I think it's best for anything over double digits numbers of doors, but it won't apply to anything that is under 5. So just how the normal analysis goes, where if it's still residential, if it's 1 to 4, and then if it's over 5, then it starts becoming commercial. Just because then, and it's even more powerful the more units you have, because of economies of scale. Your supplies are cheaper, your insurance is cheaper. That doesn't matter anyway with the spreadsheet, but it's available is the point. So let me see. I'm also going to drop the link into the chat here on Zoom, and the chat I'm going to put in there our investor quiz. So if you guys do want that, I just did redo it. And so hopefully it give me some feedback as well. I'm trying to change some buttons and some images and some things to see what's more user friendly. But if you're on there and you're like, oh my God, I'm not going to click through like 11 little questions, let me know. But I just changed it yesterday. So that is the way that you can take our quiz, get qualified, and get into our deals. So, all right, we're like an hour into this. So if y'all have to peace out, that's totally cool. I am recording this. So if you want this, my email is admin@theapartmentqueen.com. And if you can stay, what I'm going to do real quick is I'm going to flip over to an image of our ecosystem. And I'm going to try really hard to summarize this as best as possible. I know I can be kind of verbose, but really, so we're creating a landing page right now that will make this more clickable and more interactive. But this is just an image of what I have found in my journey to get into commercial real estate. My journey came from a path of being in different phases of my life. So this is really just mirroring where I was. Phase one is more about, getting your insurance, taking care of your health, making sure that you're okay, overcoming hardships by you can even utilize our app to access a therapist that's built into the app. And you can make direct consultations with her. We're working on making it kind of like, what is it, care.com or the apps where you can actually have a in-app consultation. So again, this is in beta. So for now, you can just access their contact information and go direct to them. But basically, you're looking for peer group support. So we have our Women Who Invest Wednesday group. Hey, look, it's my bed. We have our Women Who Invest Wednesday group is a great thing to get involved in here. It may be a little intimidating in phase one. Sometimes you're going through a divorce, you're creating a new household, there's life changes, death, childbirth, and you need group support during those phases. And so really, again, this is part that I'm building here. We're not there yet, but looping in nonprofits to phase one. And then once you are moving from phase one to phase two, you are stable, you have a job, you're making money on a regular basis, and maybe you're in a point where you're going, okay, that's great, but what am I doing with this? Am I structuring this right? Do I understand? So we have budget 101, finance 101, very basic classes when you get going once you have a stable life and job. And so how we do this is we have a partnership that you can see at the bottom here with Erica and Karen. They own a company called Financial Literacy for Her. And so what we do is we have a referral code, again, APT Queen, that will be introduced or announced in December once they have their online courses ready to go. But it's a group class. And so instead of having some very expensive one-on-one consulting, this is a way for you to get those basic skills down with group class. And the group class also, again, has that community environment where you can stimulate your growth by being surrounded by people who also want to improve in the same way. So essentially you would be going, okay, I am, and this goes through where are you at mentally with like health, wealth, friends, family. So when you look at what phase am I in, you go, okay, maybe phase two makes sense, click. I'll go get involved with them. Then once you get through their program, which I believe is an 8-week-long program, then you'd come back and hopefully be in phase three. And this is the place where you're going, okay, now I'm really interested in getting involved in what I call the property ladder. So the property ladder is how do I take my, how do I pay off debt? So again, this is the phase where we work on paying off debt and creating cash flow or free cash flow. So Penny, with Pennywise, coaching, excuse me. She does one-on-one coaching right now, and she's working on doing some group coaching, but her one-on-one coaching is to work with you to really keep you accountable to make sure that your debt is paid off. She takes people that are, between, I think, $60,000 and $80,000 income bracket. And within a couple months, she's able to make sure that they have at least $2,000, $3,000 a month cash flow available by positioning their money in smart ways and et cetera, getting them to have some cash flow. And that's what you want to do by making smart decisions. So she keeps you accountable. And then the next phase in phase three would be, okay, how do we get involved with property now that I have a little bit of cash? When you have little bits of cash, you have the ability to do what I did and get involved with little investments. So house notes, you can use your IRA accounts for that. Or sorry, not IRA, retirement accounts for that. Or, you can invest as an active general partner if you have a certain skill set, like you can underwrite deals and you're an analysis guru, and you have maybe a banking background, something like that. You can raise capital. You've gone to masterminds and you're part of these big groups where you're able to raise capital from the groups. There's a couple of skills that you can kind of come in with, like not very much money to start, but you have to have skill set. And Marielle will help you in this program, Powerhouse Women, to decide, okay, how much time do I have and how much money do I have? Therefore, how much do I want to go active or passive? And do I want to go active or passive in multifamily or active and passive in single family? Usually, like for me, it was let's go active in single family first, or sorry, I actually went passive in single family first. It's not always the same, but anyway, it's usually active in single family, then passive in single family, then active. Because again, when you're active, it's all of the sweat equity. You're putting in some of your money, but it's a lot of sweat equity and working your bum off. But point is she'll direct you, and their program will direct you into, okay, are we going to start doing group flips for single family together? And you're going to be an active or passive investor, or are we going to do a group multifamily investment and you're going to be a passive member with us? And if you get all the way to the level where you want to be a active, or you have the skill set after kind of doing some of these other types of investments to be a general partner, active partner, multifamily, then I got to change these arrows because they should be bi-directional. You should be able to kind of go this way and that way. Then you can actually feed into our programs when you have a higher level of capital to invest, or you can do the crowdfunding offering when it's available. Or you can come in as active, and there's all these different fee structures that we try to transparently put out into the public, that once you have that level of experience as an active person, that you can make income by partnering with us and working with us. Or you can take the investor quiz and you're able to invest into phase 4 as a very well educated, no time available passive investor. And I forgot to mention these things, that our app feeds into each phase as far as getting comfortable and getting educated with what's available, getting the support system that you need with a CPA, an attorney. We have all, again, a therapist in there. Because for me, I mean, I go every week, because as the target on your back grows, as things get more intense as you become a professional, it's important to have the support, and that's being built into this app. Then also we have a summit once you get to phase 3 that is a day-long summit that shows you how to go from bad credit all the way up to building a family office. That's available for phase 3 individuals. We have a book. You can get it in any phase you want, but I think it's most applicable at phase 3. It's called Women in Multifamily Real Estate. That book shows you through a female's lens, as a broker with children, as a lender with children, as somebody who, partnered with another female that tried to destroy her. I mean, all these different things, just from a female lens in this industry, what it looks like or what it can look like. And then again, like I said, getting into the phase 4 would be the investor quiz. Now, this phase 5 that's way down here, this isn't quite built out yet, but this is basically like, you're like, oh my God, I love this sequence so much, and I don't want to stop at phase 4 passively or actively investing. I want to make this a professional career. I want to be a professional hedge fund manager. There's definitely a way to transition to there, and that would be phase 5, which would be this little thing down here that I have to, create another graphic and move it. But this is basically going to be an interactive landing page where, when you're interested in, okay, I look like I fit in phase 2, bing, I'm going to go click on Erica and Karen's program, where you could actively click and then go to another landing page that actually explains, what's available. So I'm out of breath, and and I'm done. Stick a fork in me. I'm done. So that's really the vision that I see happening. And that is part of what's coming and what we're building and what we do have available right now, which again, you can access most of this through theapartmentqueen.com in that upper tab. Let me check real quick on the Facebook. Do we have any? Nope, nothing there. All right. So Facebook, I'm going to end you there. And then I'll ask one more time real quick to see if anyone has any questions that's here live in the group investments information session. And again, I'm going to do this next month as well. Hopefully by next month, or for sure by next month, that graphic will be turned into a landing page, and I'll just, you'll get to watch our progress as we go along and get to hopefully participate as well, is really the hope. But you get to just kind of have an open forum. So if anyone has any questions, keep asking me. There've been some really great questions that y'all have asked. How do I get to the white screen? Y'all can't see my face. Let's see, maybe that works. All right. Oh, I see another question. Okay. How has COVID affected this business model? Is it sustainable? So the business model, as far as group investing, it has been the same as it's always been. It's still buying a deal. it's still, it's still finding an apartment in this situation in my industry. It's still raising money. It's still putting those two things together, closing on the deal and improving the business plan, or sorry, improving the business with a business plan. But the way that COVID has affected the industry, not necessarily the model of group investing, has been a variety of different changes. So we have a property that's in Phoenix, we have a lot that are in Texas, and each of them has been a little bit different. So for example, the one in Phoenix, that one was interesting, but it was primarily because of a fire, not because of COVID. We had COVID layered on top of that fire, but we have crazy insurance. And so when you have blood, flood, fire, we have renters replacement, or like income loss replacement in the insurance. And so we were covered even when the residents had to move for a bit. We obviously recovered money from the fire damage, and we're actually upgrading the units to where they're double what we thought we were going to be getting for rent, which is pretty cool. So actually what we think we're going to do instead of selling that property is refinance out like a lot. I'll just say that because they told me not to tell people what it's going to be, but we're going to refinance a lot out per door instead, and then be able to make the investors whole. And so it was interestingly advantageous. Now, we had some properties that were in really small tertiary markets during COVID, and for those properties, it was interesting because typically what we call agency or Fannie Mae, Freddie Mac, big government supported debt structures, CMBS, et cetera, will not typically go or be a reasonable cost in a tertiary small market. They want to be in a primary market. So because of that, we had bank debt. So a small bank lent on those properties. And what was happening during COVID is the EIDLs that you took, or the PPP that you took, or the the forbearance that you could take on your mortgage, that was all related to those federally backed loans, to where they could then limit you and say, well, if you're going to take out these programs, then you can't evict people. Then you can't do certain things with your business plan anymore. You have to either stop taking the forbearance or whatever. So on none of our properties, we didn't take any of the forbearance. And so we were able to continue to collect when a lot of people couldn't anymore. And then on those bank-owned properties or bank lent properties, we were still able to continue to evict, and it didn't matter. There wasn't technically a moratorium on our debt until the second round, but by then we had gotten rid of all the people who decided to take advantage. And because there's a difference, like we had people that really couldn't pay, and you get some proof of that and you work with them, you know what I mean? Like, okay, we can put it on a credit card, we can split it up, you can pay 3 times this month, we can even have one person work for us. I mean, you become flexible because you want to keep your good residents. But anyway, for the most part, long story short, we're able to be more flexible with getting the bad ones out. Whereas some of the larger properties we had with government debt on them, we had to keep the baddies in there for quite a while until we could actually do something. So that was probably the most challenging part. But really what it is communication, proactivity as a team whenever we see something coming down the pipeline. I mean, there are many, many mornings that I was up at 3 a.m., 4 a.m., looking at the most recent government regulation that was released, looking at the CPAs that I trust, videos that they would create on how to deal with it, and being educated, and then communicating and disseminating that information to my other active operators. Hey guys, here's the 4 options. Which ones do we want to take? Here's the pros and cons. Sometimes on one of them, we were afraid of people leaving. So instead of, some people like waived late fees and did different things. You just had to be creative. We did pizzas. So instead of going backwards and saying, oh, we're going to, collect less or whatever, well, let's instead thank our community for choosing to be here. And they seem to really appreciate that. So, I mean, just having a proactive approach, I think, was really important. And again, pouring back into your community, because that's what this is, multifamily anyway, is a part of. So I think it's definitely sustainable, and it always has been throughout the years. But as far as what is the purchase price that you're purchasing at, because you make your money on the purchase, not the sell. You have to basically buy it right. That's the first thing. So this market now makes that very hard. Then as far as the liquidity or the reserve accounts that you have per unit, for example, and the amount of debt, you can also get too much debt and over leverage for sure. And after surveying a lot of lenders that have way more experience than me, I think that anything over like 75% leverage is too much, and it's going to turn into an advantage, I think, for us to look at, like I've been calling banks for months. Hey, I see someone's 90% leveraged. When are they 90 days past due? When can I make an offer when they're distressed? So we can come in and find some opportunities to help them out of a bad situation, but obviously help our investors get good returns because we get a deal. So it's all about being proactive, paying attention, being conservative, keeping extra reserves, not being over leveraged. So most of the time on our deals, we over raised like too much money, but all that happens is we put it in an interest bearing account. It either goes to fix problems that we didn't expect to happen, or to fund an oopsie, oh, the government now requires us to replace all these windows and we didn't have to do that a year ago. You never know. Or that doesn't happen, and then it just gains interest and we send it back to the investors basically as part of their return. So you just have to buy right, I think, and be communicative and proactive and conservative. So I think it's sustainable. Another question, have you been featured in the Bigger Pockets podcast yet? No, and I would die to be, but I haven't been able to meet Brandon Turner, like handshake yet, so Lindsay, if you have any ideas, I'm totally open to listen, because I definitely have a message that I want to share. And as this ecosystem gets created, I think it's going to help a lot of people. So I'm excited. Lindsay, oh my gosh, okay, yeah. So my email, if any of y'all need it, is admin, ADMIN, at theapartmentqueen.com. Again, on Facebook, I'm not even sure if it's streaming live anymore, but I think it is. No more comments there either to answer. One more shot. Any more questions I can answer? I don't see any. Okay, so Jeannie, Lindsay, Simone, John, Kaylee, thank you all for coming this evening. And thank you, Tim Price, for popping in as well and making a comment. Again, we're going to do this again next month so we can kind of track things as we go. And next month, I think what I'm going to cover is take this presentation, really squeeze it down. And really what I'd like to cover is how you can take money that you don't understand, that you already have, that's trapped in houses, that's trapped in retirement accounts, that's trapped in different assets that you already have, that you can use to pull out, how we can leverage that. And sometimes, for example, if you already own real estate, I taught my girlfriend Carrie how to pull $1 million out of all of her rentals so that she could then invest in 5-6 different multifamily deals and double her money in a couple of years. So, I'd like to talk about that next time. So thank you guys so much for your time, and I'll see y'all next month. See ya.